Okay, the Apple financial model is now largely complete, but for what we've classified as other financial statement items. Now, other financial statement items are basically residual items that aren't really main drivers of the business, but you need to include them so that your financial statements reconcile with, say, your opening balance sheet. Mm-hmm. You can't build a model and then say, oh, we just couldn't be bothered modeling other stuff, including like other current assets. So we include these things. Now, with a lot of businesses, they're quite small numbers. With Apple, surprisingly, they've got other financial statement items in the tens of billions, which is just extraordinary. But it's all relative, I suppose, to your revenues and so forth. But it's still extraordinary just how many other financial statement items Apple does have. In a normal business, normally this would be like 5-10% of the net assets of the business. In this case, a lot of it is other financial statement items because they've got so much cash that they're doing strange things with. So in this section, we're going to talk about two things we're going to include in the model to enable it to pretty much reconcile with their Form 10K, opening balance sheet. And that is interest on cash and other balance sheet items. We're not going to bother with other revenues and expenses. They're very small for Apple at the moment. And on top of that, if you want to include those, it's exactly the same process as what you did for revenues and expenses. They just go through the income statement and the cash flow statement. You assume earnings equals cash. And it's just really where you want to put them on the financial statements that matters. It's easy to add. You can look at the example, the more complex example of the Apple model we've got at the end of this. That actually has other revenues and expenses, but I think we've set them to 0 because we haven't included them in this. But you can see how they flow through. So first of all, let's focus on interest on cash. Now, interest on cash is something that in some models you might not even bother including it, given that the interest rate's so low at the moment and probably isn't going to go up a lot in the next few years, and most companies don't have a huge amount of cash. Apple, as always, is a weird business. So if you look at Apple on their other income expenses on there, or as we said earlier I think we looked at this in the debt course. Mm-hmm. We looked at the debt interest expense. They roll their interest revenue and their interest expense and their interest income and their interest expense into other income expense net, which if you go to the notes is comprised of interest and dividend income of 3.8 billion, interest expense of 2.9 billion, and then some other stuff. It's only 87 billion. You probably just walk away with that, they wouldn't even notice.
87 mil.
87 mil, who cares? So basically what we're going to do is we're just going to use this as a proxy. So interest on cash is quite an interesting one. So for Apple, they're not a simple business. So in most models, you can simply take your cash at bank, and that is predominantly the majority of your interest revenue source. So for example, with our business, we've got interest on cash at bank. The bank pays us no interest. It's almost negligible. It used to be in the old days, you used to get 3 to 5%. Now you get almost nothing. Apple's interesting because they've got so much cash that if you look at their balance sheet, they've got cash and cash equivalents. They've got cash and cash equivalents of 38 billion at the end of FY20. They've even got marketable securities of 53 billion. Then they've got marketable securities non-current of 101 billion. What marketable securities are literally they've just gone out and said, we've got too much cash. Let's just go out and actually lend this cash to people. They're still effectively like cash. They earn interest on them, but it's basically them lending out like commercial paper and all sorts of other bits and pieces, where they've basically gone out and they're lending money like a bank. So if you actually add those up, Apple has an enormous amount of cash and marketable securities, which they earn interest on. So if you look at the notes, they earn interest on all of these different things. Then they have a whole summary of the different instruments and all sorts of stuff. They've got a wide range of different rates. The funniest thing is they earn a higher rate in some of their instruments than they actually pay the bank on the cash, on the debt they've borrowed. So they technically could just become a bank and stop selling phones. But they wouldn't make anyone who has much money. So if you look at the notes, the 3763 of interest and dividend income in FY20 represented a weighted average interest on its cash equivalents and marketable securities of 1.85%. Okay, so that implies an average, that's according to its notes in here, 1.85%. Now, if you do the calc on that, if you divide that interest by 1.85%, you end up getting 203,405 of total, so the denominator on that calc. Mm-hmm. So if you then actually go and look in here, you say, okay, this is broadly consistent with their cash and equivalents and marketable securities, which decreased from 205,898 in 2019, which is the sum of this column's three rows, down to 191. So if you assume it's sort of predominantly increased, they paid off a lot towards the end of the year, that's pretty realistic in terms of a good proxy.
Yep.
So you can sort of say, if you take all these numbers, now the problem we've got in our model is that normally when we do interest on cash, we just multiply the cash and cash equivalents. So the cash at bank number, the forecast by a rate would give you a number. In this case, a lot of their cash is not in the cash at bank number. So in this case, they've got of their odd 200 mil here, or what is this, 191 bill. in FY20, they've actually got only $38 billion sitting in their bank account. And that doesn't include the restricted cash that's in other current assets. So it's a weird situation here. It's just sort of like, okay, what do we do? The simple way we've worked around this in this model is we're just going to actually add that to the cash at bank. We're going to forecast these numbers and add them to the cash at bank. So you'll see our opening cash here, we're going to use opening cash as the basis for forecasting interest on cash. And the reason why we've done that is because you get a massive circular in your model if you don't. So if you think about opening cash, the opening cash balance, the cash balance, the closing cash balance on your balance sheet in each period is a product of whatever the movement in cash was during that period. Your opening balance plus your movement in cash gives you a closing. The change in cash includes the interest revenue for the period. So if your interest revenue is calculated based on your average cash balance is after taking into account the interest revenue, so it's circulars. And you get people that put these iterations on their computer, or they just make a whole mess of their model. So it has a circular and it iterates and it won't calculate properly, just so they can do this. Now, overcomplicating it. So unless your cash balance is dramatically moving rapidly, in which case you can do some proxy calculations for your average cash balance, which don't include a circular, which we've done before. Most of the time, you can just take the opening balance. And in any case, if you're accumulating cash, that will be a conservative forecast. If you're running down cash, it's probably a bit it's probably a bit unrealistic. But in this case, it's not going to be a problem. We are accumulating cash, so it's a conservative way of forecasting. You can also sort of factor into your interest rate the fact that you're using the opening balance. Okay, so you look here. We've got our opening cash balance here. Note that our opening cash balances of 38,016 was our opening cash balance for our opening balance sheet. So that's what we're going to be using. So you look at our interest in cash forecast. If you go to the forecast assumptions, go to our interest on cash at the bottom. You'll see that what we're doing is we're forecasting opening marketable securities. Okay, now opening marketable securities, we just said, okay, let's just assume, I think we just said we're going to repay $5 billion a year. So I think we just said, okay, let's start with opening marketable securities, which they were of 153,814. So we actually took our opening marketable securities as the sum of that. What do we take? We took the 52,927. Then we added the 100,887. That gave us the 153,814. That we then put in here as the opening balance, and then we're just assuming they pay back $5 billion on the basis that. Maybe interest rates will stay down. I don't know. Well, to be honest, we just want to put something in. So it's up to you what you put in there. This is where, again, if you were doing apples analysis properly, you would actually model their marketable securities as assets. You'd model them as being a bank that lends, and you'd have the rates on each of them, the terms on each of them, the fees on each of them. But if you're building a simple model, you can put them as other current and non-current assets, which is what we're doing in this section of the course. And then you can put a rate, you can add them to your cash, and that'll give you a pretty accurate forecast. You've got to remember, financial models are a card house of assumptions. There's a lot of argument for saying keeping it simple is actually pretty good. Because who knows what the assumptions are anyway. So we're going to basically take the opening balance of cash. We're going to add the opening marketable securities forecast assumption for each period. We're going to multiply that by the all-in rate, and that's going to give us our interest on cash forecast. And you'll see we've got that note there. Interest on cash is calculated based on opening cash and marketing securities balances. Marketing securities are added to cash at bank when calculating interest revenue. Okay, so if you then look at how this will come out during FY21. Interest on cash will equal the sum of the opening balance of cash, which is 38,016, the assumed opening marketable securities balance of 153,814, multiplied by the all-in assumed rate, interest rate of 1.85%, which we've put in based on the implied rate from FY20 staying the same. As a result of this, during FY21, interest on cash will equal the sum of the opening cash balance of an equivalence balance of 38,016, the assumed opening marketable securities balance of 153,814, multiplied by 1.85%. So that's going to give us 3,549, so 3.549 billion. And you'll see how that's reported, very similar to normal revenue. That's where most revenues and expenses in a financial model you report as income statement and cash flow, and then you make adjustments if they're necessary for non-cash. So in this case, the only difference is interest on cash is reported normally between EBIT and net profit before tax as part of interest expense. And that's why Apple on their income statement reported it as part of sort of other revenues and expenses. We like to report it as part of interest expense because people like to see the difference between EBIT and net profit before tax because it's an indication of what the net financing, net interest position of the company is. which for Apple is extraordinary because it's a revenue stream, as we keep saying. So in this case, the interest on cash is going to be, for FY21, is going to be 3549, and that's going to come through as an other operating cash flow. And I mean that is, it's not part of cash receipts, it's not part of cash payments, it's part of other cash flows along with interest and corporate tax. So they're not part of cash receipts and cash payments, but they're still operating. Okay, so that's how it's going to flow through. So it's very similar. So in this part of the exercise, we're going to have to add the interest on cash to the income statement and cash flow, and we're just going to have to add the net interest calculation to the income statement to finish the income statement.
Yep.
So let's start by adding interest on cash to the income statement. Go to the income statement and to A of the table of contents, and go to row 19 and just put interest on cash in column B.
Got that in.
Cash in column B, cool. And we're going to put in the formula here. We just need to make sure we get the opening balance of both cash and marketable securities. So equals open brackets.
So just make sure that I expand my cash before I do that as well.
Yeah, you're right. So open your cash. Yeah, open your cash on the balance sheet. You're going to have to open those rows so you can actually get to them. Okay, so equals open brackets and do opening cash, which is that 38 billion, plus, and your forecast opening marketable securities balance. So forecast J56.
There we go.
And then close the bracket on that, and then multiply that by your 1.85% all-in interest rate.
Great.
Perfect.
So I've got 3549.
3549 is correct of revenue. All right, which is exactly what we expected, the 3549.
Yep.
Okay, so now we just need to add the net interest expense line. So go to row 21 and just add net interest expense in B21 as the heading. And then the formula in J21 is just equals sum J19 to J20. So just get those two, some interest on cash and interest expense, copy that across. And we just want to put a dashed bottom border above in cell interest expense because we're going to group these rows.
Cool.
Okay, so
do that
control 1, that shortcut was. Go to the borders, hit the dash bottom border and do that. Okay, and copy that across. Great.
Cool.
So now we've got that in there. So now we just need to obviously make sure we change our net profit before tax calc because it now needs to equal EBIT plus net interest expense.
Plus.
Okay, which is J18 plus J21.
Yep.
Okay, and that's perfect. So our balance sheet's not balancing, so we've included our interest on cash in our income statement, but we haven't put it in the cash flow statement yet. So it's going through retained profits, but not through cash. Okay, so now you're right. That should give you at the end of that period. That should give you net profit after tax of 58547.
58547, yes.
Increasing to 62104.
Yep.
Let's just group rows 19 and 20.
Cool. So group those. Data.
And you can leave them expanded for now. For now. And now we just need to go to the cash flow statement. So to make this balance, let's go to the cash flow statement. Interest on cash is an other operating cash flow. So we're going to go to row 20. We're going to do interest on cash. And again, we're just going to equal this to the P&L. I hate these cross financial statement links other than NPAT and cash, changing cash, but we're doing this because it's a training exercise. Please review the model at the end of this to see how this is done properly because it breaks my heart teaching people the wrong things, but it's definitely the only feasible way to do this course in less than, say, 8 hours. Okay, so we need to obviously, interest on cash equals the income statement, and then we're changing that formula to include plus 22 J22 at the end, copying that across.
Cool.
Yeah, in your balance sheet, but you're not balancing. Okay, so what have you got on? Have you got equals? So let me see a formula. IS J19.
Interest on cash.
J19.
19.
So that needs to be J19. And this is why we have error checks, everybody.
Yep.
So J19.
And then
bring that
just
back.
to drop that back over there. So obviously there were the two different data points. So we'll drop that back in, fill that across, and everything.
And the balance sheet balances. And that's exactly why we have the balance sheet check. Okay, so now we put interest on cash coming through as in between EBIT and net profit before tax. We included net interest expense so we can then compact it up and hide it away. And we included interest on cash as an other operating cash flow, so not part of cash receipts and cash payments. Our balance sheet balances, we now have interest on cash. So now when Apple forecasts changes of, say, dividend payments, for example, dividend payments, tax rates, increases in revenue, increases in margins, the cash at bank will be reflected in the interest in cash forecast based on the forecast interest on cash interest rate. So our interest on cash is truly reflective of the cash flows of the business going forward, which is the key. Okay, so as I've noted before, we aren't going to include other income, other revenues and expenses. If we did, it's really up to you where you include that. if you were going to include other revenues and expenses in your model, which we do in the example at the end, but we put them as zeros, we normally include them as part of net operating expenditure. So if you go to income statement, you see how we've done in the income statement net interest expense there. We would actually combine, we'd put other revenues and other expenses. I would normally put other revenues above operating expenditure, and then I'll put other expenses below it, and then you'd group those 3 rows and call it net operating expenses, and then you group it up so that your gross margin will go gross margin, net OPEX, EBITDA. In this case, we're ignoring other revenues and expenses. We modeled exactly the same way as you'd model interest revenue or revenues or expenses. They're just extra items in the financials. So again, if your forecasts aren't material, you can either ignore them or just model them very simply. So with other revenues and expenses, we normally model them as a differences approach. So in this case, you'd have, if you look at my screen, 87 million. You might say, okay, let's just forecast 100 million of other revenues. That's it. And just bang that through. You could put it as one line if you want. We're not going to bother for today because there's no extra learning in that for you. Okay, so the final part of this model is the other balance sheet items. Now, the reason why we need to include other balance sheet items is if you go to your opening balance sheet right now, there's a whole lot of holes in it. And the numbers don't really reconcile with the closing Form 10K FY20 Apple balance sheet. So we need other financial statements to actually make this model reconcile. Now, in most examples, this is where this whole exercise has been really interesting, because in most models, other current assets, other non-current assets, etc., are small. In most businesses, they're a tiny part of your assets. So with our business, for example, we're mostly salaries and wages, some marketing costs, and then we have on our balance sheet we have receivables, cash, a small number of creditors, and then we have tiny other items. Like they're almost negligible. Like they're literally 1% of our net assets. Whereas with something like an Apple, because we haven't modeled everything specifically with drivers, we're in this weird position where we have marketable securities. If you look on my screen, I've highlighted here on the actual balance sheet the items we haven't modeled. Now, if you just work through these quickly, marketable securities would be modeled as forecast marketable securities. Each one will be modeled probably as different instruments with different rates, with different terms, different fees, all sorts of stuff. Then with your vendor non-trade receivables, you'd model them as another debtors class. And you'd marry them up against your non-trade income, which you'd have to break out of your income wherever that is in the financials. Your other current assets are only, I say the word, 11 billion, which it's less than 10% on 143. Where it gets interesting down here is the marketable securities would be allowed for if you model them properly. Other non-current assets here is just 42 billion.
Just casually.
Just casually. So it's a weird situation, because when we put all of this into our model, we're going to end up having like half the balance sheet value is not going to be modeled properly. But the reality is we have modeled the key operations of the business, which is its revenue, its COGS, its OPEX, its working capital, its overall, its debt, its equity, its assets. But this is a business that has an incredible amount of cash, and it has an incredible amount of random balance sheet value that comes from its ridiculous amount of cash. It's got debt it doesn't need. It's got enormous amounts of cash. It's got securities it's issued because it's acting as a bank. And then its other current assets, its other non-current liabilities are 54 billion. They don't even break them out in real detail in the Form 10K. So whilst in this exercise, we are going to just assume these are other, with the models you build for your clients or of your business, it wouldn't be this dire. If I was going to model Apple, I would probably spend a month breaking down this data, deep diving, and becoming obsessed with knowing what every line item was. I'd want to know what the regions were, what the exchange rate impacts were, what the different debt instruments were. I would be obsessed with that data. But ultimately, the funniest thing about that, when I was in banking, one of my managing directors used to always say, you could do that, but ultimately it's going to come down to how many iPhones will they sell next year? How much will their services pick up? And you could probably get a similar position on what you think their actual earnings are going to be from the model we're building. So again, it comes down to how obsessive compulsive you are, how much it matters. But in this case, you do need to include them to make the model work. Okay, so to make this model reconcile, let's put these in. Now, the way we model other balance sheet items, it's really up to you, right? They're basically whatevers. So when someone says, I've got other current assets of 10 billion, that sounds ridiculous, but in most companies it might be like 500,000, and on a balance sheet with net assets of 20 million. So you're sort of like, I don't really care. So most of the time, people just, if you know what's driving them, you'd normally model them using drivers. If you don't, you'd model them flat, so the balance sheet balances, or you'd model them just using movements. The approach we've used, if you go to the forecast section of the assumptions, 1C, is we've just put in other balance sheet items, and we've just put plus or minus millions, which means we're just going to take their opening balances and we're going to add and remove depending on these periods. Now, it's kind of weird because if you had real clarity on this, I've just assumed they're sort of all increasing, like whatever, right? But if you had some real clarity on this, you probably wouldn't include them in other. So it's a weird situation. So you see, we've also put in this, we've put, this is a final little piece to fry your brain in this course, but it's really valuable, right? And that is the way to model something when you don't know what it actually is you just need to think about some core rules as to how things flow through the financials. So in this regard, if you want to throw something on your balance sheet, if it's an asset and it increases, then you need to make your balance sheet balance, you need to put through a negative cash adjustment. And the way I actually view that is, if you put suddenly a building on there, it's probably because you bought it with cash. So cash goes down because adding that asset hasn't changed. If your balance sheet balances, your net assets can't have changed. Or if they have changed, you have to increase. You could increase equity, but normally, if you're just adding one item to your balance sheet, then your net assets has to stay the same. So what you do is you offset it with a cash adjustment. So for example, if you added 100 of other current assets to your balance sheet, you'd have to say, well, for my net assets not to change, I need to reduce cash by 100. So cash becomes your plug. So when you're modeling other balance sheet items, what you do is you add them to the balance sheet and then you put the movements in those balance sheet items through as cash adjustments. The basic rules that will serve you well for life on this are: an increase in assets requires a corresponding decrease in cash adjustment, an increase in liabilities requires a corresponding increase in cash adjustment, and an increase in equity requires a corresponding increase in cash adjustment. The way I always think about that, and I have for 20 years, is if an asset goes up, it's probably because you bought it. So you've probably spent cash. If a liability goes up, it's probably because you borrowed money or someone's given you credit, in which case you owe them money. So in this case, they're basically, like for example, debt goes up, cash goes up. So you've probably somehow got money that you've got to pay back at some stage. That's why it's a liability. An increase in equity, that means somebody's put money into the business, which I mean, obviously the only increase in equity comes through retained profits, which is normally an increase in profitability, which increases cash, or through somebody issuing shares, which increases equity, which is an increase in cash. Okay, so those three rules are what I've always referred to as the financial modeling equivalent of debits and credits, and they hold true no matter how you're customizing a financial model. So when you start frolicking and adding all types of complex things to your debt instruments and like asset write-offs, you sit there and you go, okay, it's an asset write-off. How is that flowing through? What's that doing to the balance sheet? How does that have to impact my financials? Okay, so the key to this is understanding which increase in assets, decrease in cash, increase in liabilities, increase in cash, increase in equity, increase in cash. That's the adjustment. One step further is then saying, I have no idea what that other current asset is. Generally, other current assets relate to operating cash flows, but you don't know what. Because if it was a receivable, it would be in receivables. You know, if it was inventory, it would be in inventory. So you're sort of sitting there going, I don't know what that is. So for safety, the movements, the cash adjustments you put through for these other current items, you generally with other current assets just assume it's part of operating cash flows, but you don't really know where it is. So I normally just put it in as part of not cash receipts or cash payments, because you don't want to distort it. It shouldn't be material anyway, but you want to sort of say, I don't know what that is, so I'm just putting it through as other. Okay. Right, so in that subset, that third subset of the operating cash flow part of the cash flow statement. Now, movements in other non-current assets are by default assumed to be investing cash flows. A good example of another other current asset is a plant, property, and equipment. It's weird that it wouldn't be in depreciable assets, but maybe it is. Who knows? But if it's non-current, who knows? So often we just put that in investing. If you have clarity, you don't have to. Yes. You can. So in our models, in our more complex models, for each line item, we allow the model user to select where they want it to be allocated on the cash flow, just so your cash flow classification is what you want. But in a simple model, you just say, I'm going to assume that goes to operating. I'm going to assume non-current assets goes through investing, not other current liabilities, operating, because that's again sort of like whatever. Current. Other non-current liabilities, financing, because you sort of think, well, if it's a non-current liability, it's probably some type of borrowing at some point.
Yeah, loan, etc.
Yeah, loan, etc., debt, whatever. Yeah, some type of agreement, whatever. And then other equity are by default financing cash flows, because equity is normally financing. So when you think about that, you end up in the situation where, to make it really clear, you look at financial statement impacts and you look at what we have in our assumptions, which is 500 increase of other current assets, 1,000 increase of other non-current assets, 50 increase of other current liabilities, and 250 increase in other non-current liabilities. We haven't bothered with other equity, but it's exactly the same thing. That would just be an increase in cash. So you see here, we'll just put other equity, no movement. But here you've got your other current asset increasing by 500. And you'll see we've put here decrease in other current asset, because a decrease in another current asset is an increase in cash. Here we've got an increase of 500, which is a decrease of 500. So it's a negative cash adjustment. Our other non-current assets of 1,000 They are in other non-current assets. The decrease and increase. This one's increasing, which is a negative $1 billion investing cash flow. Okay.
Yeah, so it's the same as the working capital.
Same as working capital. Very similar. Increase and decrease. So exactly. So an increase. So debtors, decrease in debtors is an increase in cash. It's exactly the same. Same rules. They're rules that apply specifically to known assets and liabilities. These are residuals. So then other current liabilities, increase in liability requires an increase in cash adjustment. So that 50 increase is a 50 adjustment to cash. Other non-current liabilities, 250. Imagine debt's being raised. That's a 250. So you end up with your 1200 impact on cash, no impact on net assets at all because they're all being plugged through cash. So the net impact of the assets and liabilities movements comes through as a net asset 0 because they come through cash. So that there is the 1500 asset increase, which is a decrease in cash of 1500 with the 300 increase in cash. So it's 1500 down, 300 up, net 1200 down. And that's how it works. So that's how you need to view these differences. And this is where people get stuck. The number of times people, I mean, we see it all the time. People come to us for support and say, I added a line item to the balance sheet and the balance sheet won't balance. And we're like, okay, what are you offsetting that with? And they'll say, I tried to put it through here. We're like, well, that's an increase in an asset. You've got that the wrong way around. So if you get this rule right, you end up in this unbreakable position where you can customize financial statements any way you like, even if you don't know what you're doing. They'll always balance. And that's when good modelers say to me, a balance sheet still balances, the model must be right. I'm like, you're assuming you know what you're doing. Which a lot of people don't. So when you start modelling, the hard thing is the balance sheet keeps disbalancing because you struggle with this stuff. Then you work out how to always balance the balance sheet, and then the challenge becomes actually understanding where stuff should go. Because I can always balance a balance sheet. But if you ask me, are you sure that that's how that should be treated? I'd say, I don't know, I need some tax advice. I need some accounting advice. Okay, so now let's go and put these through. So you'll see what we've actually done in the Apple financial model, and it's pretty tricky. We've actually gone through and we've said, okay, we've put in all the items that we know. Some of those we're back solved, like with the dividends payable, we put that in based on the fact that dividends declared were all unpaid. With our interest expense, I think we assumed 1/11th was outstanding. So
1/12th.
We've sort of 1/12th, 1 month. So we've sort of made all these assumptions. You go to the opening balance sheet. We've made all these assumptions about these different items and what they are. So what we've done to create these numbers now is we've just gone to the Apple Form 10K and we've just gone, okay, well, in the 10K, what's our total current assets? What have we put in? And we've just plugged it. Everything else, which you can look at in the answer file. You can actually see the broken out formulas in the answer file. But we're just going to put them in as hard-coded numbers. So other current assets, we're going to put 85,516. Okay, and that's right. That'll give you 143,713.
Yep.
Okay, other current liability, other non-current assets, we're doing 143,409.
143,409.
And that'll give you 180,175.
Yes.
All right, and then we have other current liabilities of 32581. Which with that one we've actually taken balance. We've taken the balance. Now don't forget, with this, we moved all of our debt, long and short-term debt, into non-current liabilities. So when we did debt, we have changed our current liabilities, non-current liabilities from what's in the Form 10K because we haven't modelled short and long-term debt.
Yes.
So that's why you'll see the total current liabilities difference we've got is different to Apple's, but the total liabilities will be the same. So let's just finish this. Did you get 91,623 for total current liabilities?
Yes.
Yep. Now let's put in other non-current liabilities of 54,490.
Yep.
And that should give you 166,926.
Correct.
Okay, cool. So if I just go to the Form 10K now, just check that out. Form 10K, here we go. Okay, we have statement of share balance sheets. Total assets should be 323,888.
Correct.
Okay, our total liabilities, you'll see they've got total current liabilities of 105,392.
Yeah, bit off.
Whereas we have 91 because we've taken out the term debt and the commercial paper of 4,996. But our total liabilities should be 258,549.
Yes.
Which it is. So our actual total shareholders' equity, which is 65339.
65339, yes.
So this reconciles perfectly. So obviously our problem here, if you're obsessive compulsive, is you're like, wow, I've got $143 billion of other non-current assets. We know a lot of that is marketable securities. So the obvious thing you do there is you would customize this model to break that out, add drivers, work out what the financial statement impacts are. The interesting thing about modelling that is that's like modelling the reverse of debt.
Yes.
Because your revenue is your interest on that asset.
You become the bank.
But it's not hard to do. The interest expense would come through as a revenue line item. And that might have a receivable on it, which you might have a receivable. You might have interest receivable sitting somewhere, which would probably be part of your probably about other current assets. which is why the other current assets are so big as well. They could have interest receivables in there for 1 month worth of interest receivables on their own marketable securities. But that's the difference between a complex model and a simple model. Is a simple model just goes, that'll do. Complex model goes, I'm going to filter this down so that none of my other balance sheet items are more than about 5 billion.
Mm-hmm.
You can have fun doing that if you choose. Okay, so let's put this all through. This is just some grunt work we have to do now. And it is quite fiddly, good practice, but a bit fiddly. Okay, so let's go to our balance sheet. And then what we're going to do is we're going to add all these items. So in each case, we're going to add the other item to the current assets, non-current assets, current liabilities, non-current liabilities. We're going to add the other line item, and then we're going to update the total for that area to include it. Okay, so let's do this. So the first one, other non-current assets in row 17. Let's just go to B17 and put other current assets as the heading. And then for the formula, now remember what we said. So with other current assets, an increase in an asset. In this case, it doesn't really matter. We're not looking at the cash flow yet. So what we're going to do here is we're going to go, okay, we're going to just, in every instance here, we're going to say if it's the first period, all we're doing is taking the prior period and adding the movement. Mm-hmm. So the formula is going to be very, very similar. So it's going to be if the period number equals 1, take the opening balance sheet. So in this case, opening balance sheet J19, so dollars J19, which is the other current asset number.
I'm on the opening balance sheet here. So I want J9.
Yeah, opening balance sheet J19.
J9.
I say J9, sorry.
Yep.
J9.
Yep.
Dollars J9.
Dollars J9.
Otherwise, the prior cell on the balance sheet. So click on the balance sheet, and I think the prior cell is going to be I7. I7 there.
Like that. I7.
I7. And that's the prior
17.
period. Oh, I17. Sorry, my bad. So the number it says if J$7 equals 1, the first period, you're taking the opening balance sheet J9.
Yep.
Otherwise, you're taking I17 and close that bracket.
Yep.
And then you're adding to that the forecast assumption. So go to your forecast, and that's forecast J63, which is that 500.
Perfect.
Okay, put that in.
Fill that across.
And then with the total current assets, you can use it. You can just extend that sum. So you can extend the sum J14 to J17.
Mm-hmm.
Perfect. Now the formula here is incredibly similar. So what I would actually do myself is I would, in this case, mate, what I did when I created this is I would take that whole row, other current assets. I'd copy and paste that, because that is an easy cheat. Paste it down to row 21, and then change that to other non-current assets. And because we put the row absolute on this, it's still going to say if J17. So you just got to get that opening balance sheet. So you see the opening balance sheet needs to be J13 now, if it hasn't already got it right.
Yep. So J13.
So it's got it right, which is just luck. You shouldn't assume it's going to happen. Otherwise, the prior period is the same, is I21. So it's saying if it's the first period, take J13. And then you've got to add, the forecast is J64.
Yep, so one line down.
Yeah, so if you traverse that formula, you guys don't have this if you don't have Modano installed, but if you just traverse this formula, you'll see that it's basically...
Perfect. Here we go.
Yep, it's basically, if it's the first period, if it's that period, it's taking the other current assets from the opening balance sheet, otherwise it's taking the prior period plus the movement there. Okay, perfect. And now we just need to update the total non-current assets formula in J22 to J20 and J21. You can use alt equals on that. Yep, perfect. Alt equals to do it automatically. Okay, might as well do these other ones manually, I suppose.
Yep.
Okay, so other current liabilities in row 30. You'll see you'll get very, very familiar with the if first period, and that's why you could put a true false. You could put a true false
flag
in the period title rows if you wanted to. I'm so used to writing if J whatever equals 1 because I'm used to this structure that I don't notice it.
Yes.
But if the first period, in this case, we're going to take the opening balance sheet J22, which is the other current liabilities balance, so dollars J22. Otherwise, the prior cell, which is I30.
Cool.
And then we're going to add the forecast assumption.
The movement of 50.
50.
Or J65.
And I think you've got to get rid of the balance sheet thing in there.
Ah, thought I got rid of that.
Yeah, it's very annoying. It doesn't matter if you leave it. It's just annoying. Okay, we do that, and then we just need to, total current liabilities just needs to be J26 to J30.
So I can also alt equals that one.
This is going to be a big test to see if the balance sheet balances after all this. You've got to make sure you get it right. Okay, so now we just go to other non-current liabilities in row 34. Exactly the same formula. So if you're quick, you would have just been copying and pasting down the rows and editing the formulas. It's the type of stuff where you can be really quick, and if you get it wrong, you can spend longer trying to work out where you went wrong than doing it slowly. So it's always a catch-22. You just got to be really careful. I think when I first did this exercise, I copied and pasted down, and the balance sheet didn't balance, and I spent 10 minutes trying to work out why. and part of it was also because I didn't copy across one of them properly.
Yes.
No, the total. I edited the formula and didn't copy the total across.
So I will get rid of that little BS.
So that formula should be equals J7 equals 1. If J7 equals 1, opening balance sheet J26, otherwise the prior sell, which is I34, plus the forecast J66.
Yes.
And what I did, and then you've just got to increase total non-current liabilities, just got to Alt equals that and copy that across. What I often do now, given you've got this beauty, I select everything from J12 right down to net assets. You can even do it to there, do it to the very bottom.
Yep.
Yeah, I copy that to Control C, and then Shift Control right.
Yep.
And then paste it the whole way across, and then Enter. Yeah, there you go. I just do that because it copies the whole thing across. So that means if you got some error in your first period, if you'd forgotten to copy something across, it would get it. And that's the beauty of everything being consistent across columns.
Yep.
Which very few financial models in the world do, but you should do in every financial model. You should be physically punished for not.
Perfect.
So the balance sheet's still not balanced. We've put all of those through. We're in really good shape. You can just verify this, see if you've got the right balances here. So you should have, for total current assets at the end of 25, you should have 207,971.
Yep.
Total non-current assets 192,975.
975, yes.
Total current liabilities 152,494.
Yep.
Total non-current liabilities 146,401.
Yep.
Net assets 102,051.
Yep.
Okay, so our balance sheet still doesn't balance because we've put through all the balance sheet forecasts. We haven't put through the cash flow movements for those. So we need to put through those cash flow movements to offset those, so they're going to adjust cash to do that. So it's funny, our net assets won't change at the end of this, but our cash figure will, because it will balance. So it will, because cash will flow through and fix it. But our total equity won't change because our income statement's not changing.
Yeah, we just need to fix above net assets.
Exactly. Okay, so let's go to the cash flow statement. And with the cash flow statement, we're going to do this in 2 stages. We're first of all going to start by doing the other current assets and liabilities adjustments, which we're going to do with a detail row in 23 and 24. So let's go to C23, which is the heading cell. We're going to indent this like we did with cash receipts and cash payments, and we're just going to put decrease in other current assets. Cool. And then we're going to the row below. We're going to put increase in other current liabilities.
Let's change that to increase in other current liabilities.
Increase in other current liabilities. Now remember, an increase in an asset is a decrease in cash.
Yes.
Okay, so that's why we've put decrease in other current assets. So because we're forecasting movements, which is increases, we need to put a subtract on that. So in J23, we need to negate the movement. So equals negative and go to the forecasts, and then go negative. Forecast J63, which is our movement we're forecasting.
Yes.
That's that movement there. Now for the next one, the liability, copy that across if you like. Next one for the liability, an increase in the liability is an increase in cash, which is why I've got increase in other current liabilities. So this one is equals forecast J65, which is the other current liability down there.
Awesome.
That's the 50 increase. So put that across. Now we need to put a bottom dashed border on that, which is Control 1, I think I use. Control 1, dash border, bottom.
And I'll fill right.
And now we just need to put the net of those two is going to be our other operating cash flows. So we're going to go in column B in row 25, and we're going to put other operating cash flows. And we're going to sum those. So equals sum 23 to 24. And then we just need to adjust on that the net cash flow from operating activities. So we need to make the next cash flow, just add that. Add that. Beautiful. So it should be J14 plus J19 plus 20, 21, 22, and 25.
Yep.
Okay, after doing that, net cash flow from operating activities should start at 68,917 and increase to 75,039 in 25. Great. Balance sheet's still not balancing because we don't have the movements in other investing cash flows. And we don't have the other investing cash flows and other financing cash flows.
Yep.
So let's do that. So
we'll just also quickly group those rows before we head off.
Yeah. So let's group rows 23 to 24. Just perfect. Right click on them and click group. Yep. That way we can group those away. And now, so let's go to the other investing cash flows. So row 29, we're just going to put other investing cash flows in B29. We don't have multiple impacts on this one. We're just doing other. Do you remember what the other investing cash flow is impacted by?
Other investing cash flows, that would be an increase in an asset. So I'm going to say non-current assets.
Other non-current assets, exactly. So this one we just need to put the increase in non-current assets, and it's because it's negative.
Mm-hmm.
We just do equals because it's other investing cash flow negative forecast J64. So
negative J64. Perfect.
Yep. So it's an increase in an asset is a decrease in cash.
That's it.
And across, and then adjust net cash flow from operating activities to equal J28 to J29.
Mm-hmm.
That should be okay. Great. And we'll do the numbers in this in a minute. Finally, other financing cash flows in row 37. This is going to finish our model basically. Other financing cash flows. So it's down there.
Yep.
Great. And then we're just going to. This is literally increase in a liability is an increase in cash. This just equals. This is the increase. This is the movement in the other non-current liabilities.
Yep.
So it just equals
J66.
forecast J66. And then if we do an alt equals on the net cash flow from financing activities, drum roll, our balance sheet balances.
All works.
There you go.
Bang.
It's always a good feeling. So if we collapse the time series period title rows 5 to 8, and we can close the other operating cash flow detail rows in 23 to 24, our cash flow statement is now complete. So right now that looks like just a massive hunk of information, but now you should be looking at it as little digestible pieces, as little modules. The cash payments was made up of revenues, which we modelled separately to debtors. The cash receipts was made up of operating expenditure, which we modelled separately to COGS, which we modelled separately. COGS, which we modelled separately to operating expenditure, which we modelled separately to inventory, which we modelled separately to creditors or accounts payable, and then we did interest on cash towards the end. Interest paid was part of debt. Corporate tax paid was part of corporate tax. Other operating cash flows was part of other balance sheet items. So after doing this, you should have a net change in cash held of 39,080. We know it's got to be right because the balance sheet's balancing. And then moving to a net cash outflow because we're paying out huge dividends. We're paying down debt, which we think Apple will do. You can't sit on this cash forever.
Yep.
So then moving down to 2892. So if you now, 2892.
Perfect.
Outflow. Okay, so the model's now complete, right? So it now contains opening balance sheet, three-way financial statements, fully integrated, operational, working capital, assets, capital structure, corporate taxation, interest on cash, and other balance sheet items. So if you pick up a model that someone else has built, doesn't matter how complex it is, you can now go, okay, let's look at the revenue. Where have they done that? Where's that going through? They should, if they've built it properly, have used this approach. And that's how I pick up the most complex models in the world, and I re-engineer them back to this. Just like with this one, you could now say, okay, let's add a whole bunch of financial statement items. Let's add marketable securities. Let's break out debt into different tranches. Let's include different types of equity and different types of whatever else Apple might have. Let's break out the revenues into different products across different regions. But ultimately, you've got your infrastructure now, so no matter how complex you make this, you're still going to have a balance sheet that balances. And every time you make a change, after you finish putting the changes through your balance sheet, so still balance, you're now in a beautiful best practice world of balancing integrated financials. Okay, so if you go to the income statement now, and you can just click on the top of the income statement now, click on the level 2 sheet level view and just collapse that. And you see now you've got a beautiful income statement. Your net interest expense is compacted to show just the net, which as we know for Apple is a revenue stream because their interest revenue is greater than interest expense. And you're forecasting your different line items, which you can now use as the basis for doing like dashboards. So in the example, we'll include the more complex example, which is still a simple model. The more complex module example we'll include at the end of this, which you can download. We'll include a couple of dashboards and some cool outputs to show you how this really comes to life. And layering on things like evaluation or scenario analysis is really, really easy once you've done this. And we've got a lot of information on our website and training courses that show you how to do that as well. But this is the key bit to understand, because once you understand this, all the principles are just these. They're just like taking 50 different sticks and piling them up a certain way. The key is being able to decompartmentalize. So our income statement should have net profit after tax going from 58,547 increasing to 62,227.
Perfect. That is it.
Go to our balance sheet, which we know balances because the error check isn't triggered. And we're forecasting net assets of 7194 in FY21, increasing to 9759 in FY25.
That's it.
Okay, and that is, assuming you've made it this far, that is your first full integrated three-way financial model. Now, we've built this course specifically to get you to a point where you understand how powerful modelling can be, so you understand how this works. We always have an adage in our firm, once you've built a model from scratch, you do it so you never have to do it again. Very few people, once they understand this, you normally start with a template and hack, or you use something like Modano and automate inserting modules and swapping in debt and all sorts of things. So this should give you an understanding of what's happening when you pick up a financial model, whether it's a modular Modano model or just a spreadsheet someone's giving you from an investment bank or an advisory firm. You should be able to use this. We're going to continue adding new training courses to our website that'll layer on top of this, working right up through things like scenario analysis, DCF valuation, advanced tax, advanced assets, working into things like LBO, M&A, project finance. All the principles are the same. The principles you've learned in this course are 90% of what you need to know to build the foundations of a proper construction operating project finance model. It's all very simple concepts. It's just more detail. And that's what people really struggle with, is if you can build this model, you can pretty much build anything. You just need to understand the layers of complexity you're adding.
Just following the same principles.
Same principles. And I've been doing this for 20 years, and this is the black box that people struggle to understand. This is the bit you don't get unless you've been in an investment bank or a corporate strategy team, or you've paid somebody $3,000 a day for training. This is the bit we want you to have, because the next bits are the fun stuff. So we hope you've enjoyed this. There's lots of links around. If you're watching this on YouTube or on our website, there's lots of links to additional resources, and you can always reach out and give us a call if you want to discuss and need support. So thanks for participating. We also have an accreditation exercise, a certification exercise at the end of this we're putting together, where you can build a model. I think it's going to be of Tesla, where you can build a model from scratch and test that you actually understood this. It's a bit of a game, bit of a fun game we've put together. See how you go. It's pretty interesting business as well, Tesla, but we'll save that conversation for later.
That's the next course.
Next course. But either way, thanks for watching, and we hope to see you again soon.
Great, thank you.